Hey everybody, I'm Jared Levy, Director of Investment Strategies here at DBHW. Wanted to welcome here to our second quarter of 2026 market recap and outlook video version. This should accompany the document that we sent out. Oh gosh, it was the second week of July. It was the written version of our Q2 recap, and you can kind of follow along, but sometimes it's helpful to have a face behind all of the words. Obviously, Q2 26, one of the strongest quarters for US equities this century. I know it's crazy, right? Because we've been expanding for so long. But, what we saw was that panic that sort of set in Q1 with the war, turning into what was a melt up in Q2. So let's talk about number one, the equity comeback. The S&P 500 up nearly 15%. It was the best quarter since Q2 of 2020. The NASDAQ was up over 20%. Okay. Now, remember, for some context, this follows a downturn of about 4.3% in Q1 in the S&P, and that was brought on by the US-Iran conflict. And what we did see was a broadening rally. It wasn't just the, Mag 10, the Magnificent 10 stocks are rallying. We did see an expansion rally happening within value stocks, large cap, small cap, mid cap. And in fact, one of the nuances of our portfolios and equal weight S&P also thrived in the period. So that's really good. The Russell 2000, which is all the small cap stocks, they were up 22% for the first half of the year. It's the best first half for small caps since 1991. Pretty impressive. Obviously, semiconductors stole the show. They were up 80 plus percent in the quarter. Now, keep in mind these semiconductors, these chip stocks, as much as we want to get excited about them, that type of volatility, should be something you should be a little concerned with. If you're thinking about jumping in or if you hold it, I'm not saying if they're going to go down or up, but when you've got 80, 85, 87% movement in a quarter, chances are you're going to have similar movements, and those movements may be down in following quarters. So keep that in mind. What else? So, quick mention, Google added to the Dow. That was a big one. That was back on June 29th. And SpaceX, new IPO, which again has sort of floundered a bit, it was added to the Russell 1000. So, what are the two big stories driving performance in Q2? Number one, Iran. We saw a de-escalation in Q2 of the war. There was an agreement made in Islamabad, 60-day negotiation window. Oil fell about 40% or so from 118 down to 73. Obviously, post quarter end, as we record this video, some 2 weeks after the quarter, we've seen a rise, a resurgence in those tensions. And that's something we've been talking about here at DBHW, that it's going to be really hard for the current administration to, negotiate with people that have nothing to lose. And not just that, even if you negotiate with one, with a regime, for instance, or one group of people, there are other factions that could go out with a little RPG or a drone and do significant damage and cause, death and hate and discontent and all the mess with a small weapon. And here they are with these smaller weapons and small boats, and the US is spending, billions and billions of dollars on heavy machinery. So that's one thing that we do have concern with. All right. And definitely two big stories. The second big story was the new Federal Reserve Chair. Chairman Warsh took the helm on May 22nd. The June meeting was his first. He definitely is out there to make a statement. Mr. Chairman Warsh has, obviously folks have thought that he is a little bit of a, we'll call it a Trump puppet, if you will. I hate to use those terms, but a lot of people have, that he's going to be at Trump's beck and call and just lower rates as Trump wants. But Chairman is pretty staunch on saying, what, that's not my operation. That's not what I'm about. And I'm going to prove it. And almost to the point where he's now shifted the sentiment to where markets expect a rate hike or two this year, completely different from where we were earlier in the year. If you guys remember, a lot of traders were looking for rate cuts. So that's a problem we're going to have to sort of deal with here. And impressively, markets have continued to sort of move higher. Even we know we've seen some corrections here in the past couple of weeks. Markets have drifted higher, even though rates are now sort of turning maybe to the upside. So let's talk quickly about the bond market. Fixed income market bonds were up a modest 0.67%. And that's for the ag. The 10-year yield rose to close to 4.5%, which again, as an investor, those sorts of numbers make you nervous, make me nervous. When bonds are selling off, rates are rising. And if people are selling bonds, they've got two things going on. One, they don't have faith and credit, maybe in the bond market, or two, they want some more risk. They're ready, right? And obviously, rates themselves have gone higher. So there's a couple things pushing and pulling on the bond market there. That's something that we're watching. As we've said before, this is for the past 10 months. We've been talking about this for the past year. We don't believe, we didn't believe that rates were going to drop precipitously. We thought higher for longer, and that's what's happening. The good news is we are seeing a little bit of cooling in inflation. So CPI, the Consumer Price Index, and PPI, which remember, those were boosted up because of the surge in energy prices and oil. Those are starting to come down and moderate a little bit. Now, with the fact that we're kind of back on with our conflict, who knows what the next few months hold. But we do believe that those inflationary pressures will be transitory. So what's ahead? What are we looking for? Well, we're paying close attention to, geopolitics, to most importantly, the Federal Reserve's policy. Are they going to be hawks? Hawk means, are they going to keep rates high or move them higher? If they do that, you can expect to see some corrections in the stock market. The stock market does not like high rates, and obviously that would affect American consumers as well. What are key dates we're looking at? Well, at the end of this month in July, the FOMC meeting is there. We don't see much happening. The big meeting for us is going to be in September. That's the 15th and 16th. We'll get a new what's called dot plot or economic projections from the Fed, which they're limiting those. So we'll hear kind of a little bit more juice, if you will, in that September date. One of the other things we're watching is the forward price to earnings ratio, or the level of expensiveness or cheapness within the S&P. And right now, it is far above the historical average. So again, we're kind of thinking that stocks are a little bit overpriced here as we move into the late summer and early fall. The other thing I want to mention is what's called a wide dispersion, or there's a huge delta or difference between what some analysts believe the S&P is going to end. Some believe it's going to end all the way down at 6,000. Others think it's going to end at 8,250. I mean, that is a wide swath. And I think the largest bank, their bearish outlook is about 7,400, somewhere in there. That's from Bank of America. So when you've got that wide of a dispersion, that tells me that there's not a lot of confidence, and there is maybe some underlying bearishness that we have to be careful about. We're also watching AI. We're watching the level of expenditures that these companies are putting out. We want to see, first of all, our investors saying, all right, yeah, keep spending, keep building these data centers, keep dumping money into AI. If investors are cool with that, which by the way, they were not cool with that when it came to a couple earnings, including Micron and some others, Oracle. If they are not cool with that, we could see the broader market sell off, because again, it's that AI spend that's been driving things so much higher. So that's the other thing we're doing, or watching rather. And again, what's the next best thing? We've been investing in things like water, in infrastructure for both AI build out and for America's power grid. We've been investing in defense, which obviously has proved to be good. We've been investing in higher quality names. Okay. So as we move forward, some of the things that we're doing within our portfolios is we're remaining diversified. We have what's called a barbell approach. We're not going all in on AI. We're not going all in on fixed income. We are being very cautious, and we are keeping our portfolios very balanced and hedged. We've also trimmed, and we did this several months ago. We've trimmed some of our AI winners, some of the semiconductors. We redeployed that money into some more value type plays, cheaper areas that we believe have been ignored. Okay, areas of the market that, those value plays. We see value being a big theme in Q3 and Q4. Some of the other things that we've been doing is keeping ourselves shorter term in duration when it comes to fixed income. What does that mean in English? Well, we're buying bonds with very short term maturities for the most part. And the reason for that is, we don't know where rates are going. We don't believe that rates are going to drop here in the near term. And we do see a risk of rates going up. And the way to combat that is to stay very short on what's called that curve, stay short duration. And, last but not least, the bottom line is this. When it comes to our investing here at DBHW, we've managed to outpace, I believe, all of our benchmarks for all of our major models for the past year to date period. That would be year to date up to July 1st. And what we are noticing and what we continue to strive for is lower volatility in our portfolios. Okay. We believe that discipline, not heroics, are going to be what wins in this marketplace. I think that it's very easy for some people, as they've said, to go out and make some good money in these markets. But um, the problem is that ease comes with volatility, comes with risk, and we're doing our best to diversify as much of that risk away so that you're not feeling those same rifts, when the market does end up correcting. I want to just thank you all for being clients of DBHW and for tuning into this. Hopefully, we'll have a lot more of these videos on the way for you guys with a lot more information. But for now, cautious tone, still cautiously optimistic on the economy. But we are seeing again those fragments in the labor market and some earnings reports that are not sitting as well with us as I think that they should. But again, overall, you sort of can't deny that markets still have an underlying strength, at least overall, and we're riding that strength as we go into Q3. Again, I'm Jared Levy. Have a great day. We'll talk to you soon. Thank you.